The broadcast is now starting. All attendees are in listen-only mode.
Hello, welcome to Investors Observer's Members Only Workshop. My name is Bobby Rains. I'm the senior analyst here, and I will be talking to you for the next hour or so. If you have questions at any point, you can go ahead and put them in the question box. I keep an eye on that, so if you're asked about something that is what I'm talking about right now, I will sometimes answer it right there in the moment. Otherwise, there's plenty of time for questions at the end. So here is our sort of agenda today. What's going on at Investors Observer, what the Fed said last week, judging by the questions we got ahead of time and what it looks like is in the box already. This is something a lot of people are thinking about. I got a couple of non-Fed related charts we're going to look at. And then the rest is questions, some combination of questions people send in ahead of time and questions that you ask right here during the presentation. As always, if you send in a question ahead of time, I can put together slides, or it can, in some cases, just play into how the other prepared material works. Just, mention the workshop or reply to that workshop invite is what a lot of people do, and we'll get to it. All right, so what's going on in Investors Observer? We talked about this a little bit last time, but we are building an app. Very, very soon, some of you should get an announcement that you can download the app in the App Store. We're going to sort of do it in waves. We don't want to invite a bunch of people right up front and break anything. So we're going to invite some people and then wait a couple of days and then invite some more people. But yeah, it's going to be out there very, very soon. I don't have the exact date, but we are targeting this month. So that gives you a relatively small number of days to sort of try to guess about. So yeah, it'll be iPhone only at first. Android development will come later. And you can sign up for a chance to win $500 or an IoT shirt at this link at the bottom soon, investorsobserver.com/app coming soon. And you get extra chances to win if you share the page on social media and some things like that. So that's still happening as well. There's only a couple days left on that piece because, we're not going to do the app pre-launch campaign after the app launches. So, if you're interested in that, by all means, get in on that soon. All right, so what the Fed said. So the Fed said, there's a lot of talk. The short answer is they said they might raise rates twice in 2023, and they're sort of talking about tapering asset purchases. But let's get into some of the stuff from that report. Everybody talks about the dots, but the dots aren't the only thing that's in there. So here are GDP expectations for years from March at the bottom here and June at the top. So you can see the forecast for June, the forecast from June is considerably better for this year, right? A full half a percentage point from 6.5 GDP growth to 7 this year, and then 2023 also gets a little bit better. I don't know. I don't understand exactly the thinking behind leaving 2022 the same and raising 2023, but there we are. And then longer run, you're at 1.8, which is about where it's been recently, pre-pandemic anyway. So that was part of the raising interest rates conversation, is the economy is doing better than we expected conversation. That part tends to get kind of left out of most of the media coverage I have seen. All right, so about those dots. This is, if you haven't seen it before, this is the dot plot that everyone talks about. So this is the dot plot from March, okay? Each one of these dots represents the opinion of one member of the Federal Reserve Board plus the regional bank presidents. So nobody's expecting to do anything in 2021. Back in March, 4 people were thinking we might want to raise rates once or twice in 2022. And what is that, 2, 5, 7 we're predicting some change to interest rates in 2023, and this is basically the longer run, which is not defined as 2024, but also not 2024. Think of this as healthy economy, everything sort of going along normally, where the various governors would put rates. All right, so yeah, that's the non-emergency rate, as the bullet says, is a good way to think about that. All right, so the June dots. Yeah, the other thing that is important to note here is there are 18 dots and there are 12 votes. So there are 12 regional Federal Reserve banks, and there's a rotation. Six of the presidents of those 12 regional banks get to vote at any given time. So, for example, and also you don't know whose dot is whose here. So all 18 get to put a dot in, but only 12 get to vote about what rates actually are. So, for example, Jim Bullard, who is the president of the St. Louis Federal Reserve, is not scheduled to vote in 2023. And he tends to be pretty sort of hawkish on inflation. So it's entirely possible that one of these high dots is his, but he doesn't vote. So let's look at the June dots. The June dots, you have a few more people thinking maybe rates will go up in 2022, but that's not really enough. Yeah, it seems unlikely that it would break that would be enough to actually raise rates. Also, just the internal politics of the Federal Reserve are such that if there's a tie, things will pretty much go Jay Powell's way. And he seems to be pretty interested in being dovish here and not raising rates too soon. So even if all of those raise in 2022 dots are active voters, you end up with something pretty close to a tie, and I think it probably ends up with some kind of weird split vote, which would be kind of strange. Anyway, yeah, the average 2023 dots are just 2 hikes by the end of 2023. But again, some of those higher dots may not vote in 2023. There's 6 dots there that don't vote, and we don't know which ones are which. And yeah, the reason the Fed raises rates is to cool inflation, but there's also some aspect of policy normalization. Again, right, where you're trying to move back toward the non-emergency interest rate environment, which you can see there is some variation in where people think interest rates should be in sort of normal non-emergency situation. All right, so this is a fun chart. It was in an article we posted, I think, late last week. But yeah, so what you got here, and this chart is from prior to the most recent Fed meeting, but the point still stands. So the green line is the actual Federal Reserve rate for the last, what is that, 15 years, since 2006. The blue line, right, these little guys, are the price of futures, right? So Fed funds futures at various points. And the Fed funds futures are usually based on the dots, right? Because if the Fed says, hey, we expect to raise rates, well, then if you're trading Fed funds futures, you're going to probably try to keep your guesses on where Fed funds will be at something approximating where the Fed says the Fed funds rate will be. That just kind of makes sense. And then, yeah, this little dotted line over here is the pre-meeting dots. So what this chart tells us is, 1, a forecast is not set in stone. And 2, the forecasts have been consistently high. There aren't a lot of places where the blue line goes below the green line or to the left. Right? Like, people have consistently expected the Fed to raise rates, and they haven't. And part of the reason they've had that consistent expectation is because the Fed has said, hey, we might raise rates soon, and then they haven't, because I think it was Ben Bernanke who frequently used the phrase data dependent, right? The economy hasn't been at a point where they felt like they needed to raise rates, so they don't raise rates. That's how that works. All right, so more stuff about the Fed. The thing about those dots are, right, the forward guidance, as that's called, is a policy tool. So the idea is, right, rather than the sort of Alan Greenspan Federal Reserve regime where he was very careful to never say anything that anybody could make heads or tails of, the idea here is the Fed is communicating what it's thinking. Okay, so the Fed can say, hey, we got this, without actually changing interest rates. If people are worried about inflation, you can say, hey, we might raise rates, and that gets people to worry less about inflation because they know the Fed is there and on it. Okay, so there was a period where Powell said we're not even thinking about talking about, I think specifically he was talking about asset purchases, but in any case, tightening monetary policy. The point of that was to signal that under the conditions at the time, which was the middle of last year, there was no reason to even start planning for normalization, right? But now we're in a point, the economy is recovering. It's recovering a little faster than previously expected, right? That increase in GDP expectations from March to June. And so now normalization is on the table. And so the thing is, the Fed controls a very short-term rate, right? It's called the overnight rate. I think there's some facilities that last about a week, but that's about it. Okay, so anyone for the longer term, lending for the longer term, needs to anticipate rate changes. So by signaling that they think things are looking better, the Fed is sort of sending a signal to the market that, like, hey, monetary policy conditions might get a little tighter, because I don't want to just jack up the short end of the yield curve with no warning, without giving the long end some condition. So essentially what happens is, by the Fed saying, hey, we might raise the short-term rate, the bond and other sort of money markets adjust to that without the Fed actually having to do anything. And yeah, the Fed is trying to tamp down the sort of inflation concerns. And since inflation expectations themselves can be a driver of inflation, if they signal like, hey, we're ready to stop this, it eases people's minds and increases the chance they won't have to, right? It's, yeah. So the effect of this, though, is it does sort of shift what the risks are right now, and that's kind of what we've seen in the market over the last week. Is the risk has gone sort of from overheating to the Fed acts too early. So the yield curve, which normally you would expect to be, if you just think about a curve of interest rates across maturities, so at the short end you have overnight, and you've got your 2, 3, 5, 7, 10, and 30-year bond issues, you'd expect that to be sort of curved and going upwards. Longer term bonds tend to have higher interest rates than the shorter ones. Okay, so rather than getting steeper, though, the curve sort of flattened on that news. And the reason for that is long-term growth expectations may be lower because the Fed is saying, hey, we're ready to step in and stop inflation, but that stopping inflation comes at the cost of growth. And so the Fed has signaled a readiness to cool things off, so the yield curve sort of flattens out to sort of adjust for that, right? Nobody's expecting the economy to be hotter out, a decade than they were before the meeting, but people are maybe expecting interest rates in the 3 to 5 year time frame to be higher than they were before. So the Fed, the curve gets a little flatter, and it kind of shifts the risk around. So instead of being worried about inflation, now people are worried about, okay, what if the Fed comes in too soon? All right, so what does this mean for investors? Most of us who've been in the market for the last, 12 or 13 years have seen this before, right? A Fed with forward guidance that's trying to signal how it's going to handle ending an asset purchase program and raise rates from zero. We've lived through this before, right? This is 2008 through 2016 or so. So yeah, expect more volatility around Fed events. So the meetings, certainly, once every 6 weeks. The release of the minutes, probably to some degree. those have been real quiet prior to now in terms of what effect it had on the market. Just hasn't been much coming from that, but that Fed volatility is coming back. And yeah, taper talk is going to happen eventually. So that's another thing to look out for. Also, potentially speeches by various Fed officials, right? If somebody comes out and says something particularly bullish, particularly hawkish, particularly dovish, that sort of thing can move the market. Now, the thing to remember is you don't know what dot that guy is. Or I guess there are a couple of ladies, but yeah, you don't know what dot the speaker is. And so it's really hard to know, if somebody comes out and says we absolutely should raise rates in 2023, you don't know if that person even gets to vote. They get a seat at the table, but they may not get to vote. And also, they may change their mind by the time 2023 gets here. So we're also likely to see a little more volatility around economic data releases. I think we're looking for probably a return of what we call the bad news is good news trade. Okay, so data that's a little bit worse than expected probably means the Fed doesn't hike as soon, right? If that, you ease off those GDP growth expectations, Fed doesn't hike as soon, rates stay lower for longer. And the opposite is also true, right? So things come in a little bit hotter, maybe the Fed hikes sooner. And this isn't just inflation numbers. This is things like the unemployment report, some of those other data releases that come out that signal how good the economy is doing. Better than expected numbers could actually be sort of bad news for investors in this case, because it means the market's likely to have a sort of bearish reaction to that. Whereas something that's sort of in the Goldilocks zone, right? Don't want it to be too much better than expected. What you want it to be is like in line with or just a little bit softer than expectations, right? We don't want the economy to actually, double dip. We want a continued recovery. So we don't want it to be too cold, but also not too hot, right? Sort of the ideal sort of range for this is in the sort of Goldilocks zone, sort of at or just a little bit below expectations. But yeah, all the sort of broad-based recovery trades still work, right? The recovery is still happening. Reopening trade still works. We'll talk a little bit about some of the market internals on the next couple of slides. But also money is still relatively cheap. So there's room for tech and other growth sectors to rise as well. All right, so these first couple of charts are from a different piece of software than I normally pull them from. This is what I stare at all day. I think the other chart's a little more colorful and easy to see, but I already had lines drawn on this one. So this is the one we're using today. So this is the last year of the S&P 500. Each candle is a day. So we've been kind of in this range here this is somewhere around the beginning of April. April 5th or so looks like when we sort of crossed into this range, and we've sort of tested the top of it, broken out a little bit here and there. This is before the close. We closed basically at this top line here. There's been some concern about, how will stocks break out of this, and have we hit a top where the stocks just can't go higher? And I would point to this period, which actually was a sort of wider channel, this period here back in sort of early fall, late summer last year, between the end of August and sort of October. And yeah, we were sort of in a range for a while, but this was after, stocks came roaring back from the, absolute depths of the sort of pandemic low. Stocks came roaring back and then took some time here to sort of consolidate. And I think that's sort of what we're seeing here. What also happened in this period, and you can see this low here, what happened last year in 2020 was the market started to come back and sort of peaked around, I think June the 8th was the time, and then it went sideways for a while, and then it went up again. And so this is that sort of the end of that previous sideways low here. This isn't the absolute low from last year. That was much earlier. And then you have this other period of consolidation, and then you have some recovery here. But what's interesting here is when this breakout starts to happen is about the time the vaccine was approved. Everyone started talking about the reopening trade. That was when the sort of real economy stuff started to win, and the big tech stuff that had been the market leadership during the depths of the pandemic, or during the initial recovery from the pandemic, was lagging a little bit. And so that's been up to here, and now we're in a different place. So let's look at some, so one thing to note here, it's the wrong chart. Hang on just a second. I seem to have done this last time too. I have the right chart. I just didn't get it in place. You know what? So if anyone's wondering if this is live, it clearly is. All right, here we go with the Nasdaq. So you can see the Nasdaq sort of has taken a different path to get to here. It sort of entered a range and peaked a little earlier, and it corrected a little bit more. But since early April, it's been in kind of the same range, but it has sort of much more definitively broken out over the last few days. This is the Nasdaq 100. It's the top 100 stocks in the Nasdaq. It's not the full composite. But yeah, the techs have already sort of broken out. We'll go to the next slide and look at, so this is the S&P 500 in white versus the S&P 500 equal weight in blue. So when the equal weight is outperforming, it means that the sort of what I'll call the S&P 490 is doing better than the top 10 stocks, right? So your Apple, Google, Facebook, Microsoft, when those are doing well, the white line tends to do well, whereas when the other stocks are doing well, the blue line tends to do well. So we had been in a period where the blue line was doing better, right? All the other stuff was outperforming, and more recently, the big techs have started to come back a little bit. So what's going on is we have a little bit of consolidation and a little bit of sort of sector rotation. And if we look at this chart, which is essentially growth versus value, right? Growth being sort of the real economy stuff. The real economy stuff really ran up during that period from when we talked about when the vaccine started to be approved until about the springtime. And now, it's those stocks, let's call it resting a little bit. And, the growth stuff, tech and other things like that is starting to outperform a little bit. These are things that happen in the market all the time. All right, so the other thing I want to talk about is how to get, hang on. I think I paused my screen sharing for a second. So let me go back a couple of slides here. All right, so here's the corrected Nasdaq chart. You can see it really has sort of broken out after being in a range for also since early April. Here's the S&P 500 versus the S&P 500 equal weight, and thank you to, I think, Stan, who typed in that he wasn't seeing a white and blue line. That tipped me off that I wasn't actually sharing a live screen. Yeah, so you can see the blue was doing better than the white, and then the white has started to take over here more recently. And then you have the same or a similar dynamic happening here with growth in white versus value in blue. The growth stuff has started to perform better, while the blue stuff has slid a little bit. All right, so let's talk about earnings season, because the end of the quarter is in roughly 7 days, and between 15 and 45 days after that, all of the companies that use a calendar quarter will be reporting earnings. So things to keep an eye out for in the run up to earnings are downward revisions from analysts. you see analysts, and it may not just be downgrades, right? It might be things like just a lowering of a price target and keeping the rating the same. It might even not even be that. It might just be adjusting either revenue or EPS estimates. Moving those things down means they're tend to be expecting earnings to not be as good. So if they notice something and start to tick things lower, that could be a sign that earnings are going to be not as good as expected. Another thing to do is consider trimming positions that have become overweight, right? Like we just looked at some charts where some stocks have, certain parts of the market have run up a lot more recently. That means your portfolio might be a little bit unbalanced. Those positions that have gotten really big, you might want to trim some of that because that means that those stocks are probably priced a little high and the market might be expecting sort of, I think the phrase is priced for perfection. And what you might just get is, you might get pretty good, but if you get pretty good and the price is, expecting perfection, the results there can be kind of ugly. Also beware of some of the hot stocks. There's still big hype in certain parts of the market, and earnings can be where rubber meets the road, not just in terms of like, revenue and EPS, but there's, those conference calls can be interesting. You can learn all kinds of interesting stuff that way. Analysts ask a lot of probing questions. It can be a time when things get disclosed that nobody knew about that aren't just, earnings aren't as good as expected. Other things to consider are international exposure. The U.S. recovery is looking pretty good. Other parts of the world are less vaccinated and things are moving slower. The Fed moving towards or signaling they might move towards a tighter policy environment also might mean there's some currency conversion risk. So especially for companies that do most of their business in a different currency and then convert it back to dollars for earnings, a sort of strengthening of the dollar there can be a negative for, dollar denominated earnings. And then, consider supply chains. Does your stock or company need a lot of specific commodities or chips? Lumber prices have fallen a lot, but only a little bit of that is due to a lot more lumber being on board. A lot of what's happened is just people saying, hey, I'm not paying that. I'll wait. And this is actually a positive sign, right? Like if there's a price that the market will not bear and it comes back down, that's the market working correctly. What inflation looks like is the price keeps going up and there's, no reduction in demand. So the fact that we saw a bunch of prices run up and we've seen demand fall back, a similar thing seems to be happening in housing where things are, prices keep going up and the rate of sales keeps slowing. There's some supply constraints going on in housing as well, but both of those things are sort of positive signs on the inflation front as things are cooling off a little bit. But if your stock needs a lot of specific commodities or chips, those things may be hard to get. So it may be that the last quarter was great, but the earnings for the next quarter, like, hey, we can only get 75% of the chips we wanted. That makes it hard to make 100% of the earnings if you can only make 75% of the product. And then there's still shipping constraints and other things like that. So if your company does a lot of importing or other things, has some sort of complicated supply line, those are things that you may see some earnings misses or some weak guidances coming up here. So Stan has a question here. He says, do I think supply chain, such as semiconductor shortages, impacts to revenue and earnings will weigh down estimates and actual results? What will analysts make of supply chain explanations for modest misses if the results are consistently down? The first question there is a little bit difficult to, I do think analysts are taking that into account. I also think that companies are probably having a hard time figuring out exactly where they are, right? I mean, there's all these stories about like, I have stuff in China and I can't get a shipping container to get it here. So where exactly the supply line is broken can be hard to parse. So, chips obviously we know are a thing that's hard to get, but even things that aren't chips where there's no shortage of the thing, there's a shortage of shipping capacity in certain places also. So my guess is analysts will take those sorts of things into consideration, but I think the fact that it's just sort of such a mess makes it hard for them necessarily to get it right. So I think we could see some sort of big beats or misses based on that. And then what will analysts make of the supply chain explanations for modest misses is a really good question. My guess is anybody who can conceivably make a supply chain explanation for a modest miss will do it. We saw, I forget, it's been a few years ago now, but there was a quarter that just had terrible weather. It was cold, there were a bunch of storms, more rainier weekend days than normal. And I feel like, yeah, all kinds of companies were like, oh, well, the weather was bad, so we have less demand and we sold less this quarter. And it's really hard to tell in which cases those are really what happened, and in which cases it's somebody just, using a convenient excuse. What analysts will make out of it is sort of a second order question, and what the market will make of it is sort of a different question altogether on top of that. So that will be an interesting thing to watch. Yeah, I expect to hear a lot of supply chain problems, and we really have no real way of knowing which ones are using a convenient excuse and which ones are having supply chain problems. One way to guess is by looking at guidance. So if we had supply chain problems this quarter, but we're going to raise our guidance for the year, I don't know, I'm going to want to hear an explanation for why the supply chain problems are gone, that kind of thing. All right, so into the questions. The first question we got here was from Samuel, and he said, what is the difference between personalized vertical spread trades? The conservative, balanced, and aggressive vertical spread trades are always quite close to the current price. How can I best take advantage of the trades? All right, so before we get into that too much, let's get a look at what he's talking about here. So on the options dashboard, we have personalized trades in 9 categories. They were personalized so long as you're a person who wants one of these 9 categories. So we have 3 categories of sort of risk tolerance: conservative, balanced, and aggressive, and then our 3 strategies, which are conservative covered calls and puts, diagonal spreads, and vertical spreads. So in the vertical spreads, what he's saying is they're all structured pretty much the same in terms of being close to the money, which is true. The difference is, and we can probably see just by looking at the stocks here. Yeah, so here we have biotech and technology, also a couple of bearish trades, whereas in balanced we have, retail, a sort of less speculative technology, consumer cyclical, and in conservative we have discount retail, fast food, children's retail. So just in the names there, you can kind of see like, oh, well, right, like where are the more speculative parts of the market versus the safer parts? The conservative parts of the market are things like discount retail, fast food, whereas the more speculative parts of the market are things like technology, biotechnology. So yeah, the real difference is in the stock selection. Aggressive trades tend to be on more volatile stocks. They also may have earnings soon, things like that, whereas the conservative trades are going to be less volatile, avoid earnings when possible, things like that. All right, so Kevin said, I trade primarily shorter term credit spreads, 30 to 90 days. looking to diversify the credit spread portfolio by industry. Was wondering if we could discuss how to use the search tools to identify upward and downward trending industries and markets, and also identify credit spread opportunities within those industries and top ranked companies. So part of this gets back to, right, like even if you're not an options trader, some of this is useful for you. This sector and industry tool, if you're just looking for what's going up and down, sentiment may be a little short to judge sectors and industries. It's here, but the sentiment score, excuse me, really just looks at the last 5 days. But something like the short-term technical score, which gives you an idea of what's been hot over the last couple of months, this is the place to sort of find like what's potentially trending. And so real estate, energy, and consumer cyclical have all been hot recently. Technology and healthcare less so, although obviously technology is a big sector, as is healthcare. So there's a little more going on than just that. And even you can dig a little deeper and see like, okay, REITs have been doing well in real estate, and then consumer cyclical, some financial services stuff, basic materials, things like that as far as the industries go have been hot recently. And yeah, this changes pretty frequently. So if you're interested in something like that, right, like I don't know where in the market to look for stocks, or if you look at your portfolio and you're like, I got a lot of technology in here, what should I be buying? This is a good place to try to find that. You may want to look, if you're a longer term investor, look at see where the valuations are more attractive, or look at the fundamentals. Something like that might be the way to do that. So yeah, once you sort of identify the sectors and industries you're interested in, however that is, then you can go to the options screener, and we're talking about vertical spreads. So you can find the strong industries and pick bullish vertical spreads. You can set your dates. We said less than 90 days. You can say, all right, real estate is hot. And even if you want to dig into real estate and say just the things that we just looked at, so like, what was it, residential REITs, and I forget what the other one was. But yeah, you can add categories here. There we go, there's a couple. So yeah, I mean, that's how I would do that, is just start at the one end, and you can set all kinds of parameters here for the kind of trades you want. We don't have any spreads wider than $5 in the vertical spread, so 5 is the maximum here. You can also try to avoid, you put something like a 50 in here, you'll also get rid of stocks that are maybe weak stocks in a high sector. That's a that's a thing you can avoid by using the overall score there. So yeah, Kevin, we absolutely can do that. And yeah, the other thing is, if there's a company you want, you can just go to the page for that company and look at the option trades on any individual stock. Those are also here. All right. All right, so James asked, is there any information on the merger between these two companies? This was a little bit hard to find because both of these are sort of OTC companies, but it appears that deal has been canceled and both companies have agreed to different separate mergers with private companies since then. I couldn't find an actual announcement that the deal had been canceled, but in one of the announcements that one of the companies put out that they're making this other deal, they mentioned they were making it on the heels of this particular deal being canceled. So that was how I figured that one out. But yeah, this particular deal, these two companies are no longer planning to merge as of earlier this afternoon, as far as I can tell. Carlos said, please address these stocks. All right, let's take these in order here. Yeah, so the chip stuff has been real interesting because I think a lot of people are looking for, people hear chip shortage and think chip prices must be going up, and so they want to go buy chip stocks because that should be good for them. And yeah, if you look at the last year, the stock is certainly up a lot, but it's been kind of a rocky road, and there's been some other examples of this as well. Unfortunately, I don't know exactly which chips are in high demand for what, and which ones there are a shortage of. This company description doesn't really say where things are made. It says where the revenue is generated, but not where things are made, which seems to be the big issue here. Things made in Taiwan in particular seem to be in short supply, but just looking at this, I don't see anything particularly alarming. Analysts seem to like it. The price target is higher. I mean, valuation isn't as high as it is for some other stocks, but this is also a tech company, so they tend to have higher valuations. So I don't see anything here that's particularly alarming. But I would say watch out for that volatility that has been in the chip stocks recently, just because, it seems like nobody can really figure out which are the hot ones to buy to take advantage of the shortage. All right, Novavax. All right, so I think, Novavax has a COVID vaccine that should be coming online at some point. I don't know exactly when. Also, it seems largely sold internationally. So that should be a positive, but I think there's some questions remaining about when they can get, how soon they can ramp up production and how much they can produce, and then what price they can sell it at. So it'll be interesting to see what happens with Novavax, but again, I don't see anything here that's particularly alarming. There's, a lot of these stocks I wouldn't necessarily want to hold for the short term, just because, right, there's big question marks. And the other one was CLF, which, coal and iron ore. Or maybe they're just doing iron ore now. Apparently, it was coal and iron ore at one point. You kind of like that chart. It just goes up and to the right. And there's nothing, I guess the valuation looks not great. I'd be interested in reading some analyst reports to see when they can turn this around. Tech companies and biotechnology companies can lose money for a very long time and then raise cash and not get beaten up too bad. Iron ore mining is not a industry where you can consistently lose money. So I'd be kind of interested to see exactly what that piece is about. But I mean, just from looking at the chart, it seems like a lot of people aren't too worried about that. So I'm not sure if that's a thing where you should be cautious. Like I said, I'd want to know when the earnings thing is expected to turn around. But other than that, and again, right, like analysts seem to like it. I'd probably try to find some of those reports and read them and see exactly what's going on there. All right, that is, I believe, let me check here. Yep, that's all the questions that were submitted ahead of time. So let's see what else we got here. All right, so I got a question about the electric vehicle market. And the electric vehicle market is kind of a mess. You have things that have been fraud, or where it seems like there has been fraud. I guess maybe fraud is a legal term I shouldn't use, but things where it seems like there have been misrepresentations, like Ride and earlier on Nikola. Tesla has managed to tie its stock to the price of Bitcoin, which is not great if you've looked at the price of Bitcoin lately. I don't think they're too bad. I don't think Tesla owns, yeah. So the way the accounting for Bitcoin works is it's held as an intangible asset, which means that if the price goes way up, you can only recognize those gains in earnings by selling the asset. If the price goes way down, you have to mark it down. So Tesla's cost of ownership of Bitcoin is believed to be somewhere in the mid to upper 30s. So at 30,000, they would have to report some loss on their Bitcoin holdings in the quarter, which if you're Tesla and mostly make money from selling electrical vehicle credits, those EV and carbon credits, that's the kind of thing that could swing you from a gain to a loss. And it's, kind of a shame to have that happen if you're trying to run an electric car company and you have, you took on some other weird idiosyncratic risk on your balance sheet. So that'll be interesting to see. Yeah, I mean, and then the other EVs are, pre-revenue industrial companies are kind of risky, right? Tech companies pre-revenue can usually explain we'll start doing this, right? Or we have a plan to do this. We're going to build a car factory and successfully build a brand and then start making and selling cars. There's a whole lot of ifs there that make it real hard to get to selling a car. And also, there are existing companies that already have the brand and a dealer network and factories where they make cars. You're just talking about, can they make a different kind of car? The EV market, I expect there to be sort of a lot more blood in the water there before it gets better. I am just kind of staying away from all of that because it's really hard to pick winners and losers when all of the companies are basically, pre-revenue, and a lot of them haven't actually made a working prototype yet. All right, so we have a question here about a trade in one of our portfolios that went bad last week. So the question is, why didn't you close the spread on T. Rowe Price before the Fed announcement? It was at full profit. The Fed announcement took a lot of people by surprise. Also, that trade was, let's look here, options, portfolios, closed trades. Yes, we opened that trade on the 9th, and the options expired on the 18th. And so, 3 days to go is a pretty significant amount of time value. It was in line to make a full profit if it had, stayed above, I think it was 95. But we could not have gotten the full profit if we had exited, before the Fed meeting. I believe that was the wrong ticker. This is a case where basically the stock was, below the price of our sold put at kind of just the wrong time. It's back above it now. You know, 3 days early, 3 days later, it would have been fine. But yeah, it didn't make a ton of sense to close it before the Fed announcement. And so that's why we didn't. We do occasionally buy spreads. Mostly we do the credit spreads just because they're a little bit easier. You don't actually have to put in a closing trade. The options just expire worthless if everything goes according to plan. All right, so there's a couple questions in here about inflation and stocks. I mean, I think the real risk to stocks from inflation is the Fed raising rates earlier. Right, in terms of stock prices, inflation tends to be bad for lenders, right? Because you loan a fixed amount of money and you get paid back a fixed amount of money. And so inflation can be bad for the bond market in particular. But if you think about inflation as essentially sort of, a number of dollars buying you, the same number of dollars buying you less and less in goods and services. Stocks are priced nominally based on actual dollars of earnings. So, right, if the dollars of earnings go up, whether it's because the company is growing or because there's inflation and the company is just, making sort of the same amount of money, but it's more dollars now, stocks should, I think, sort of adjust to that. And so, yeah, I think the real risk to stocks from inflation is, the sort of risk of the Fed raising interest rates too soon and stepping on the recovery. All right, so John says, how do you find out about a good OTC stocks? Yeah, there isn't really a specific membership that covers OTC stocks. All of our stock stuff is in the premium level. So the one trick I found, we don't really have any penny stock specific data. And the thing that makes penny stocks difficult to trade is there's often less data available about them anyway. So if you're trading at Robinhood and you would like to not see penny stocks, put in a minimum stock price of $5 or $10. 5 is the minimum listing requirement for the Nasdaq and the NYSE. So stocks that are above $5, you've excluded a lot of the OTC stocks. Similarly, I mean, not all of the OTC stocks, because there are some that trade for more than $5, but you've cut out a lot of them if you do that. Similarly, if you're looking for just penny stocks, put in a maximum stock price of $5. And pretty much everything there should be either, not on a major exchange or in danger of delisting from a major exchange, which, yeah, if you then use the stock scoring system, right, like something that's fallen way down and is in danger of being delisted probably isn't going to have particularly good scores or look good on the other metrics. So that is how you should do that. All right, box. All right, so yeah, I mean, the big thing right now is everything is sort of coming into the end of the quarter. So it looks like Dropbox reports late in the earnings cycle anyway. Yeah, I mean, Dropbox looks pretty good as far as all of this goes. It ranks very high in technology. Technology doesn't rank super high. But yeah, like strong stocks in a weak sector can absolutely be a play to, you would expect the stocks that are strong when the sector is weak to also be strong when the sector is strong. So, that's the kind of thing that can be attractive. yeah, I don't really have much else to say about Dropbox in particular. You know, they're rarely in the news for anything. They seem to just kind of do what they do, and make money doing it, which is, or you know, I guess not make money doing it. This is a thing that I would want to know about if I was in the market to buy Dropbox for the long term. Is, again, right, like, what's the plan to actually make money? You know, it's software. It's not iron ore mining. Software companies can absolutely go a lot longer with negative earnings than a mining company can. But you know, if you're looking to hold the stock for long term, I'd, you know, really be curious about what the plan is to start making money. Um, Clean Spark. All right. Yeah. I don't really know enough about this company. They're in a buzzy industry, is a thing that I can tell you. Right, like this whole, it's not quite as much, but Clean Spark and some other, like Plug Power, are other things that do something that's difficult to describe, that is nominally in clean energy, which is a hot place to invest right now. So yeah, I don't have anything to say against it in particular. But I will say that it's in a very hyped sort of piece of the market right now. Although it doesn't look like CleanSpark has done particularly well. But yeah, that is the sort of thing that I try to look out for, is if you see something that's in a sector that's getting a ton of press and attention, that can be sometimes a warning sign. Maybe not for swing trading or some sort of short-term trading, but certainly for you know, sort of a buy and hold investment. Buying whatever's hot right now can end up doing a lot of buying at the top. All right, so we have discussed adding a long call option strategy. I don't have a timetable for it, but it's absolutely a thing that we intend to do at some point. Because, you know, there's a lot of tech priorities and only so many people to actually you know, write the code. All right, so let's grab this one here. All right, we got a question about Apple, which is basically, will it repeat the summer growth cycle? I don't have any real reason to expect that it wouldn't. I mean, it did run up a lot in the last year, but it has, you know, taken a little time and consolidated here. So, um, you know, it hasn't really gone anywhere so far this year. You know, I'd like to see it sort of break out above this level at somewhere around 135. I guess get to 135 would probably be close to breaking out. But yeah, I don't have any reason to suspect that it won't. They tend to do a lot of selling around the iPhone release cycle, which I don't know exactly when the next iPhone is supposed to come out. But that's the kind of thing I would keep an eye on. Apple, though, in particular, is one that they tend to do a pretty good job, especially with making their own chips now, of having a little more control over their supply line than some other companies. But that is a thing that I'd be paying particular attention to at earnings time. All right, so we have another question about strategies. Yeah, why do you always recommend bull put spreads and never bull call spreads? Really, bull put spreads are just easier to manage. You don't necessarily have to have to close them. You can just let the options expire. Whereas some brokers charge even though commissions are largely at zero, some will charge a fee for exercise and assignment, so you probably want to close it up. There's also no dividend risk in terms of having an in-the-money put. Early assignment is extremely rare with puts, whereas dividend risk is a real thing that happens with the call spreads, and so it's really just sort of easier to manage for everybody if you don't if you do the bull put spreads. All right, so we have a question about this company, C3AI. This is another thing that I've seen the stock a lot. It ran up and then came back down, and it's down a lot more if you look at the 1-year chart. But yeah, I don't have a good sense of, this is another company, I don't have a good sense of what it is they actually do. I know they have AI in their name and software as a service. But yeah, large scale enterprise artificial intelligence applications is some buzzwords, but I don't know of a product, right? Like, I don't know what their product is. I don't know who uses their product. I'm sure they would be willing to tell you, but I don't know what it is. But my guess is, yeah, again, it's also a company that doesn't make money. So, yeah, I mean, it has been beaten up pretty bad, and analysts do seem to like it. So it may not be the worst thing in the world to try to buy it here, but I don't know enough about it to tell you that that's actually a good idea. It is the kind of thing that, again, I'd be interested to hear, I want to know who the customers are, or that there are customers, how big they are, what the growth trajectory looks like, and what's the plan to make some money, which are all things they should talk about, in an earnings call or in an analyst report or something. All right, we're a little over time, but I'll see if I can grab one more of these here. All right, so somebody's asking about Plug. David says they delayed earnings several times and then reported a loss, and then they announced a new customer and the stock was up. So yeah, Plug is in the fuel cell industry, right? Hydrogen and fuel cell technology. And yeah, it's another stock that was very hyped along the lines of electric cars earlier this year. Yeah, I mean, it just went up massively, and then they had to restate earnings, which I don't think was, sometimes earnings restatements are signs of some sort of malfeasance. I don't think that was the case with Plug, although I do think it was, if you have to restate earnings, you did something wrong somewhere. So it's never a good thing to have to restate earnings, but it doesn't necessarily mean you're, intentionally misleading people. But yeah, this is another company that's been around for a very long time. Yeah, I mean, Plug's been around forever. And they don't make any money. I'm not real sure what their products are, right? Like, they may have revolutionized the material handling industry, but, hydrogen and fuel cells, the promise is supposed to be putting them in cars, and I know there are a few fuel cell cars and a few hydrogen things out there, but those are science projects and prototypes more than they are real sellable products. So, I mean, it may work out for them. It may not. I don't know. They've been around an awful long time, and they don't really make any money, and it got overhyped earlier this year. And it's still super volatile because it's in one of those, real buzzy sectors I was talking about. It's not technically an electric car company, but I would sort of attach it to that group of things where I personally am just staying away because who knows what's going on with these things, right? They go up, they go down. it's unclear what their products are, what their plans to make money are, or if they even really have products. So yeah, it's on my stay away list. All right, I think that is everybody. If I missed your question, I'm sorry. If it's something you'd really like an answer to, you can hit the help button on the website and send it in to us. We get back to those pretty quickly. You can do that with any question at any time. You don't have to hold questions every 3 weeks for this workshop. The next workshop will be 3 weeks from today, which is, let's see. Oh, that's the middle of July, it looks like. So I will talk to you then. And yeah, this session's been recorded. We'll send out our link to the recording later, probably tomorrow. But yeah, we'll send that out. Thank you all for coming, and thank you for subscribing to Investors Observer. Bye.